When we did our video about gold producers, I took 7 gold companies out of the mix because they weren't really mining companies. They were royalty companies. That video was about how for mining companies to be competitive, they have to be able to replace their reserves and keep their cost of capital down while they do it. Royalty companies don't have the reserve problem, at least not exactly, because they don't have reserves. It's a sector that skims the cream off the top of the gold business, and it's worth understanding, especially now that the volume of milk is high and rising. Let's dive in. As we've said before, mining companies are a series of depleting assets. Every ounce they mine has to be replaced if the company's going to continue on. But royalty holders don't operate mines. They just own the royalties. So once they've made their initial investment, all that's left to do is get paid. Replacing the reserves is the operator's problem, and it happens at the expense of the operator. The modern royalty company was invented by Seymour Schulich and Pierre Lassonde, the founders of Franco-Nevada. It all started when the young upstart Franco-Nevada bought a royalty interest in the Gold Strike mine in Nevada's Carlin Trend from Western States Mining in 1984. Franco paid just $2 million for a 4% interest in the mine's production. Western States used the money to do some exploration, which went well. Barrick acquired Western States a couple of years later and built Gold Strike into a 50 million ounce operation that's still producing 800,000 ounces a year today. Franco-Nevada still has its interest, and all they ever invested was that initial $2 million. Now, it doesn't always go that well, especially now that gold royalty companies have become their own sector. And the space today is a lot more crowded. They all go about it in their own way to some degree, but royalty companies all buy interests in various different properties at various different stages of development. They won't all reach production and won't all pay out, but the ones that do are likely to make up for the ones that don't. The mining business, well, any business, is about risking capital to build an asset that generates a return. In mining, it takes a lot of capital, and companies usually acquire it by selling equity, then selling more equity, and then selling even more equity, with each successive round diluting the interests of the investors that came before them. Say an investor puts down $360,000 out of a total $1.2 million being raised to do some exploration on a gold property. In year one, that investor owns about 43% of this exploration startup. That money lasts the company about 3 years. And the exploration goes well, so to continue it, they have to raise more money. And after they do, the investor's 42% interest is now a 9% interest. And then by the end of year 6, it's now down to only being worth 0.7% of the overall project. And by the end of year 10, this company has spent $37 million staying alive and drilling out mineable reserves. It's barely worth anything as a percentage. Hopefully, the value of the investor's equity will appreciate as the company becomes successful. But there's no guarantees that that will happen, even if the company is successful. Equity stakes in mining companies aren't stakes in a mine. They're stakes in a business that runs the mine. That business is responsible for the cost of mining and maintaining the mine, which can vary and can easily run higher than the return that they would get from the actual metal they're mining if they just own the metal itself. But a royalty holder in most cases gets theirs off the top. The mining company operating it can print itself into stock oblivion or go out of business or sell the project to a bigger company, and it won't matter to the royalty holder. A well-structured royalty attached to the title pays the royalty holder a percentage of sales whenever there is production. And as Brian Dalton from Altius recently told me, a well-structured royalty even makes its way through bankruptcy court. Royalty investments are isolated from the typical capital costs, both before and during production. The operators of the mines solve the reserve replacement problem by reinvesting in their active projects. When a mine owner drills out more reserves in the existing footprint of an operating mine, the royalty holder doesn't have to contribute to the reserve replacement costs. They just continue on owning the royalty and get their end off the top. But like any investment, the decreased risk comes with a lower return. Franco-Nevada's Gold Strike royalty earns around $20 million a year. Barrick operates Gold Strike as part of a larger complex called the Carlin Complex. Barrick owns 61% of it, and Newmont also owns part of it. This isn't a straight across comparison, but for our purposes, it doesn't matter. This is just an example. The Carlin complex produces just shy of 1 million ounces of gold a year. That's good for about $1.5 billion in annual revenue. After mining, refining, and selling that gold and paying the royalty, Barrick is left with about $500 million in an average year. That's a whole lot more than the $20 million or so Franco-Nevada is taking home from the Goldstrike royalty. So, Franco has a smaller take than the operator, but they also don't have to come up with the capital to keep the mine running, and aren't exposed to any potential losses. Less risk, less reward. So, royalty companies collect and hoard royalty interest in a way that they hope will eventually add up to become significant. They spread their investments across multiple projects in various stages of development in an effort to create the best, most consistent return at the highest margin. They're more like precious metals denominated financiers than mining companies. In the past 12 months, we've seen the royalty sector's exposure earn a smaller total return than the producers based on their one-year stock prices. Even the larger gold royalty companies have underperformed their producer peers. They're also subject to the same political risks as the producers. It's proportional to their interests, of course, just don't tell the market. Franco-Nevada owns a royalty in the Cobre Panama mine in Panama, which is operated by First Quantum Minerals. When the Panamanian government shut the mine down in late 2023, Franco-Nevada suffered the same market consequences as First Quantum. Even though the mine made up 38% of First Quantum's revenue in 2023 and only 25% of Franco-Nevada's 2023 sales on a gold equivalent ounce basis. Remember when we did that Franco-Nevada Q3 earnings video and every line was like, excluding Cobre Panama, excluding Cobre Panama? Excluding Cobre Panama, well, losing 25% of incoming gold equivalent ounces is a pretty big hit, but Franco has managed to battle back a lot better than First Quantum. Franco had other royalties and streams to lean on, and probably expected that their portfolio and a strong gold market could keep them on top. So they jacked their dividend to get everyone's attention. A year later, and Franco-Nevada is the biggest royalty company again, without even generating the highest yield. That's another thing. Yield. You'd think that getting paid off the top and not having any mining expenses would make these royalty companies cash machines. But that isn't the way it works. This group on the screen averaged around 1.23% in total yield for the last year, which is behind the S&P 500 average of 1.32%. Because as much as they make their marks with unencumbered cash flows, even the bigger royalty companies are still growth stocks. These exploration and development stage royalties that make up their deeper portfolios, operating in an environment where it's easy to raise money, I'm speaking about the ones that do a good job of actually advancing their projects, are going to get their royalty partners paid. Even the largest royalty companies with the most expensive cash flow have extensive portfolios of development stage and exploration stage assets. They've also got teams of geologists and engineers running around evaluation properties and companies trying to finance their way into more royalties. Naturally, these gold royalty companies are going to run with the price of gold. Remember, they've underperformed their producer peers for the past 12 months. They might spend the next 12 months catching up, or they might keep on underperforming. The market's fickle. Who knows? And if you believe in the gold market, there are worse ways to get exposure. A full evaluation of these companies' royalty portfolios would take more time than we have. And besides, when it comes to exploration, nobody knows what's going to work out. In fact, from a growth investing perspective, there are a bunch of smaller royalty companies with big portfolios that could easily deliver more growth than any of these big cap brand name royalty companies. But of course, that would come at a higher implied risk. We might do another video about them later, but there are two royalty companies that jumped right out at us when we were doing this research. These companies both have market caps of around $1 billion right now, and they hold objectively great royalties in their portfolios, and they're both yielding more than all of their big royalty peers, by a lot. One of them has a stock that has outperformed the big boys over the past 12 months, and we can make a good case that it's still way undervalued. The other one has been seriously beat up over the past year. Despite generating almost as much revenue as Osisko and Sandstorm and more EBITDA than both of them put together. Now, we're going to tell you all about them in our next video, so stay tuned. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. And if you want to take a guess on what one of those two royalty companies might be, please let us know in the comment section. Thanks for watching, everybody.